Good morning, everybody. Good morning, can you hear me all right? Thumbs up, brilliant. Well, thank you all very much indeed for joining us this morning. It's great to see so many familiar faces. As those of you who've been before, you'll know we're in a new room, and it's great to see such a full room. So a very warm welcome from me. This event is simply about us trying to facilitate an environment that aids you guys to run your businesses, you know, to make decisions, to take information back to base and do with it what you will. So I really, really hope that, that you find today useful. We're going to change the format ever so slightly. Feedback from the last session was that we didn't leave enough time for questions from the audience. So today, questions from the audience are from the get-go, and I really need you to provide questions because I've got about 5 on my sheet here. So whoever's going to be the bravest person to go first will get a bottle of champagne from Laura, I think. I don't know, I'm just eating into Laura's marketing budget here, but I'm sure we can aid something along those lines. I also need to start with an apology, really, which is to say that one of our panelists called us last night to say that she, unfortunately, has been struck down by the dentist. She went to see the dentist on Monday afternoon, I believe, and I don't know the detail, but what I do know is that talking is a problem for her. So we send Jennet Siebrits from CBRE our very best wishes for her recovery, and hopefully next time she'll be able to join us in the spring session. So what did we do? I'm pleased to say my team didn't panic. You know, we know a few people in real estate, which is helpful, and names were suggested, and we thought, well, we can't go and invite lots and lots of people, so let's go one at a time. And I guess I called rank. I opened my phone up. I went to my WhatsApp chat. And I was getting, I think it's trolled is a modern sort of word. I was getting heckled, or I was certainly getting a little bit of attention from the gentleman to my far right, your left, who's very kindly agreed to stand in and fill Jennet's seat. So we spent the weekend together actually in the Middle East, and I think that I hope he doesn't start telling stories as to why he's given me trouble. But he's been very, very generous to stand in. So I will introduce Marcus in the sense that he wasn't on any of the marketing brief, but I think it's fair to say world record holder. Do you still a world record holder of a real estate prize, and he can speak for himself in a second. So we're going to go, if it's okay, Marcus to Rob in terms of introductions, and then Rob will very kindly stand up and do his stuff. So without further ado, I'll step aside. And once again, thanks for being here.
I'm going to start by saying every bit of heckling was absolutely warranted after the weekend, so thank you for putting me on stage this morning with 12 hours notice against the panel that are far more experienced and far more versed than I am in any of the subjects that you've asked me to speak about this morning. So the last 8 years I ran a private office focused on high-end residential, and we looked after some of the most trophy assets both in the UK and Europe. The transaction that Andrew referred to was at £225 million, the most expensive single ever asset for 60,000 square feet transacted in 2019. We took care of some of the most expensive rental contracts ever signed in the UK and across Europe as well. As of a week ago, I've taken the place of the co-head of UK investment team at Sotheby's Realty. So for the last week or 10 days, I've been touring the UAE alongside Andrew and my new team, and meeting various family offices and stepping into the new roles. So I'm going to be speaking predominantly from a residential perspective and a high-end residential market view.
Thank you. Ryan.
Hi, my name's Ryan Prince. I'm from a company called Realstar. Realstar is a private company. It was founded nearly 50 years ago in Canada, where I'm from. And has really always focused on what we would have historically called buildings with beds. So I moved here in 1998. I set our business up here in 2002. And really, since that time, the business strategy here has kind of been strategy-less. I've sort of looked at where we saw opportunities to find little niches in markets that we could be competitive. And so we started out in the healthcare space, moved into the hotel sector for about a decade. We owned most of the Holiday Inns in the UK for about 10 years. And then in the last 10, 15 years have moved into the residential space, which has morphed into today what you'd call BTR. So we've created a portfolio or a collection of assets, most of which are under a brand we also created called Uncle. And the idea behind Uncle was really to take a lot of the experience we had in hotels and apply the brand consistency, product standards, and approach to customer service that we've seen across all brands you'd expect in the hotel sector. So, as I say, today we're going to open 4 more buildings next year. Most of Uncle is pretty London-centric, although we do have an asset in Manchester, and we're building nearly 1,000 apartments in Leeds. The rest of the assets are on major kind of tube transit nodes around London. So that's just a potted summary, I guess.
Thank you. David.
Hi, I'm David Partridge. I'm chairman of related Argent. I've been ex-CEO of Argent for many years. We're a owner, operator, and developer of real estate all around the country. Started in Birmingham, then in Manchester, and obviously most recently here in London at King's Cross and Brent Cross, which is our new big piece of city centre regen that we're doing. About 3 years ago, I stepped down from the executive role, thinking I'm going to go into a sort of genteel semi-retirement. I've never been more busy in my life, unfortunately, and so for my sins, I'm chairing a huge cross-industry initiative around the UK net zero carbon building standard, which I'm sure a lot of you have been involved in, for which I'm hugely grateful, and a couple of startups also in that sort of in that net zero world, which I think is going to be the thing that is going to change real estate and the rest of our lives, I'm sure. So yeah, very delighted to be here this morning. Thank you for inviting me.
Well, guys, thank you ever so much. And without further ado, many of you will recognise Rob. Rob, are you going to stand here or sit there? Where would you like to be?
I thought I'd introduce myself just quickly. So my name's Rob Elder. I've worked at the Bank of England for 25 years, mainly as an economist. And my current role is essentially business liaison in London. So it's my job to talk to as many businesses as I can, day to day. And there's people like me around the country talking to businesses, and we take what we hear and we add it all up to build a sort of jigsaw puzzle of the UK economy. And ahead of every interest rate decision, one of us gives a briefing to the governor and the other policymakers about what businesses are telling us. So the bank really does listen to the business community, and I'm always interested in getting new contacts. Some of the people in the room I know are already our contacts, and I'm always looking for more. So mainly my job is about listening, but also part of it is about explaining to the business community what the bank's up to, and that's what I'm going to try and do now. So I think we've got about 10 minutes of me as an economist showing you a few slides, and then we're going to get on to the more interesting stuff.
Right. So all eyes are on you guys now. We have Amy to my right, your left, Laura to your right, my left, and it's hands up time. There we go. Thank you very much.
Thank you, Rob. That's very interesting. I was just thinking, given what you say about how painful it can be for people, even in the short term, to raise interest rates, what chance is there the Bank of England would just raise its expectation on target inflation? So rather than saying 2%, just say 3%. I mean, you said in 2024 it'd be at 3.1. Maybe then you could just say, well, we've done it, and interest rates can start coming down, because the pain that it causes to raise interest rates is so much greater than just a 1% target rate for inflation.
It's a really good question, and can I encourage people to ask questions to the rest of the panel, because
No, keep going.
It's a really great question, and I'm afraid there isn't an easy way out here. It's a really good question, and I remember the chief economist of the IMF, who's a really highly respected economist. He said after the global financial crisis, what central banks discovered is that they wanted to cut interest rates very sharply to help the economy survive the financial crisis. And they got to 0 and they wanted to carry on cutting, but there was no more room to cut because they'd taken it down as low as it could go. So he said, you know what, we can solve this problem by raising the inflation target around the world. If everybody targeted 5% inflation rather than 2% inflation, if we did that, then interest rates would be much higher normally, and therefore there'll be more room to cut when we need to cut. And the important point about the reason I've said that is because the actual outcome if we were to raise the inflation target persistently, would be to say interest rates are going to be higher forever than they would normally be if we have a 2% target. Because typically, the interest rate pays people who borrow, pays people who lend for inflation. You imagine lending someone £1,000 now and say, pay me back in a year's time, and you know that inflation rate is 10%. You know that your £1,000 is only going to be worth £900 in a year's time because it's going to be inflated away by price rises. So the interest rate you're going to charge is going to compensate you for that and is likely to be 10% plus something. Now, there are times when interest rates can be a bit below inflation, but typically interest rates are higher than the inflation rate. So if you raise the inflation target, what you're saying is forevermore interest rates are going to be higher. So it sounds attractive to say, oh, let's live with 3. But the truth is, if you do that, interest rates over the long term are going to be higher than they would be if we say, no, we're going to stick to 2. Now, I won't talk much more about this, but I just think it's interesting to note that there isn't an easy way out here. The last thing I'll say is that it's the government that sets the inflation target in the UK, the elected government, and the Bank of England's job is to do whatever the government tells it to do. So if the government would like to change the inflation target, that's absolutely fine, and we will do whatever we're told to do. And it's not our job to have a view on that, so I don't want to come across as having too strong a view on it. It's up to the government to decide that. But if you change your target, people start wondering whether you really mean it. Because as soon as you change your target, you're sort of signalling, I can do this again. And people start wondering whether they can trust it. So that's another reason to be very cautious about changing the target. But it's a great question, and I can completely understand where it's come from.
Thank you, Rob. And gentlemen, David, Ryan, developers running huge projects. We've been talking about inflation and interest rates daily, I'm sure, for a year, and probably will be for another year. Can you give us your views on how they've affected your decisions?
Obviously, the interest rates mean that the borrowing for all projects goes up. What's also interesting is the impact that it has on bond yields and on gilts. And your point about losing trust by virtue of moving targets results in higher yields on bonds, which means, of course, the value of them come down. That has an impact on us as developers and as owners of real estate, because our exit yield obviously shifts at the same time. If you can lend, you can borrow money from, or you can invest in the Bank of England, in gilts. Why would you lend it to a runaway developer like me in order to be able to go and do something with it? So yes, you get a double whammy. You get a higher inflation during the course of the loan that you're taking out, and your exit comes down, so your loan to value changes, etc., etc., etc. The good news for inflation, in a sense, is that rents should go up as well, and it'd be interesting to see. You're obviously at the top end of the market. You're in the middle. It'd be interesting to hear what other panelists say about that. But there is no doubt that renting is more expensive, certainly on the residential side here, especially in London, and I think it's across the whole of the UK. And you're seeing that as part of that services piece. That's the rise. So that does compensate us a little bit. Our ERVs go up, the yields go down, the overall GDV probably stays about the same, but the cost of borrowing is the thing that kills you. So yeah, so it's we're always tussling with all of these things, and you just need to get the sweet spot when you make sure that you haven't bought land off the basis of some expectations which weren't there, and then suddenly the world changes halfway through. If you can buy land knowing full well the cost of doing the actual full development and the value at the end of it, then you should do all right out of it. It's when you get caught in the middle that it really hurts.
Ryan.
Sure. I'm smiling because when I came here, I went to the London School of Economics, and I was sitting over there, so it's weird to sit and listen to economics. Thanks for looking this way. Yeah, I think to carry on what David was talking about, everybody, well, depending on the audience, the math from an investment point of view, and you could look at it in office and you can look at it in residential. The office world, I think, is impacted by so many other things today. It's almost too complicated to have that conversation in the same way that if you looked at retail and the impact of e-commerce, it sort of changed the paradigm in a different way. I don't think that's the case with resi. And I think, so the variables you've got are the bank accomplishes ultimately what it wants, and then there will be a very long tail and lag to self-correct, because these things take a long time to do. So as David says, to build something new today, you have much higher construction costs. You have much higher interest costs. Because bond yields are higher and the yield you can get elsewhere is higher, the expected return to an investor now becomes higher. So what you have to justify to an investor, to their capital in terms of their range of choices, becomes higher, and the yield becomes higher. So those are all negatives versus where you were, T minus 2 years in terms of your modeling. And the only thing to offset that is rents, fundamentally. And rents have grown. So I think that what you're seeing today in the resi space is rents are growing, and they're growing in the short term for a variety of reasons linked to work from home really still means a lot of people are in London, and so that doesn't mean everyone's living in Wales. It also means that, supply has gone from a target of 300,000 to, if we see 100,000 units this year, I'll be surprised. And then tax changes, landlord, legal changes outside of the Bank of England. So rents are going to grow, and I think for existing owners with existing product, I know David's just delivered a new product in King's Cross, I think rental growth should probably keep pace with interest coverage ratios and maybe even where yields and cap rates go. So you'll stay flat-ish, maybe up a bit, down a bit, and that'll be in the round. To build new, I don't think that math works today. And I think we're seeing that. And if you look at transaction volumes across the space, you can just see when you put all that together in a model, it's too tough. There's not enough rental growth to offset all those negatives until a few of those things change a bit. I don't think you'll see one massive drop. I think you'll see the curve has moved. Rob will know. What the curve is today and what it was 2 weeks ago and what it'll be 2 weeks from now. When people price off the curve, I think it's just as nuts as anything else. It's a huge moving target. So until we start to see that shift and you start to see new supply, and then you'll see a lag for 3, 4, 5 years until you can start to deliver against that to offset that rental growth. So I think we're into a whole new cycle. I think if you own things today, that supply constraint makes things okay if you're conservatively enough financed. But on the new side, I think it will continue to be tough until some of those statistics show up in real life.
Fascinating, thank you. Marcus, hanging out with billionaires every day, a lot of whom are overseas, how has inflation or interest rates or all the things that Rob just summarised affected the mindset of your clients?
Thank you. I just want to go back a point and look at the constriction of supply. And the high-end residential market is something that I classify over £10 million in the UK. And in 2018, 2019, as everybody knows, there was a change in legislation in the planning law whereby there wasn't going to be any consent for new build units over 2,200 square feet. And in essence, what's happened is that's really constricted the supply for the new build stock that we're now only coming to see now, because for the last 5 years, the stock that had been built and consented for the years prior to that was still coming through and still dripping into the market. So we're now seeing a 65% constriction of new build stock priced over £3,000 per square foot coming to the market. And that's really having a knock-on impact in two ways. The first way is obviously it's underpinning prices for best in class. So when we have, the penthouse on Grosvenor Square, for example, it's never going to be replicated anytime soon. The prices are absolutely justified and underwritten. I think going forward, I think the best in class will always trade. I think regardless of the inflation, regardless of all of the other sort of economic factors that we've just discussed, I think the best in class assets will always continue to trade. I think they're less resilient on bank financing. I think if we look at the last 12 months of the year 2022, it was the best year over the last 10 on record. If we look at the number of transactions over £10 million in the UK, in the residential market, there was 228 transactions that took place last year over £10 million, and there was 48 transactions that took place over £20 million or $25 million. That was only surpassed by one city in the world, and that was Dubai. And everybody knows the reason why those numbers are pretty distorted in their favour. But the crux of what I'm trying to say is the UK residential superprime market remains absolutely robust and very resilient, regardless of all of the other sort of economic factors that are maybe swaying up and down.
Thank you. So Just please keep putting your hands up, guys. Great, thank you. So, Mike, I'll come to you next. What just a question that was pre-presented was, and it's linked to what we've just been discussing, which is overseas investment. That affects all three of your businesses, I'm sure. So, could you summarise with numbers around 0.5% growth or 0% growth? What are your views on how that affects your businesses from an overseas investment perspective?
Do you want us to go? I mean, our investors are institutional pension funds, sovereign wealth funds. So these are investors who are looking for a return to offset pension liabilities of state employees, essentially. And so they need income. So unlike the super prime market, where I would make that more akin to the art market, because there's no, I guess your question, what you would sell is like, yeah, how do you put a price on whatever it is? Well, someone does, but there's no way to economically model that. In our world, it's entirely economically modeled, and our universe of investors are benchmarking against their asset allocations between equities, bonds, hedge funds, you name it. Yep. So I would say all the world is impacted. Fortunately, if you look at it, most of the Western countries are in the same place roughly when it comes to inflation and interest rates and so on, whether you look in Canada or the US. US is a little different because of energy costs, but they're relatively consistent. I would say the challenge in the UK today is more about politics necessarily than it is about monetary policy, because there's been a variety of things that have happened here around cladding, and where, you know, historic liabilities lie. If you look at the Marks and Spencer situation about reliability of planning and certainty of government. So I think actually the institutional investment challenge right now in the UK is more about historic certainty and reliance on UK geopolitical stability than it necessarily is about monetary policy and what interest rates are doing and so forth. Because it's such a long-term horizon that you're looking at. You know, what the curve's going to do, as I said, isn't really the point. What the world looks like in 3, 5, 10 years' time, that's much more significant to the billions and billions of pounds that institutional investors look at.
David?
Yeah, same point. We've obviously got investors from all over the world, from Australia, from the Middle East, from the US, and obviously from the UK as well. And Ryan is right. The point is, that curve affects everybody, and it's pretty similar whether it's Sonia or whether it's the US one or whatever. So everybody's looking at the same thing. So when they're saying to themselves, where do I put these billions that I can't go and buy another apartment in Grosvenor Square, unfortunately, so what do I do with it? They're comparing across the States, across the UK, into Europe, and obviously Middle East and Far East as well. And so they're saying there is the political piece. I think the thing about the UK, which is kind of fortunate, for us as developers, but not really a great thing for society, is because planning is so terribly difficult to get. We've always got this constricted supply, especially in London, but it's the same in a lot of countries, around the regions as well. And that supply restriction is the thing that keeps values going. And that's why people keep coming back, and they keep going, do you know what? Actually, it's a great time to be building offices at the moment, if you've got the cash to do it. Because in 3, 4, 5 years' time, there are going to be no new starts. So when we recover from the hiatus that you described that the retail world just went through, the office world is going through the same thing, actually, to be the only guy in town that has an empty office building, you'll be the most popular person in about 3 or 4 years' time. Today, you're the most unpopular person in the world, because you go and ask your bank or your investors if you could start, and they go, you must be mad. But that's why you've got to go against the cycle slightly, against these things. And those planning restrictions do keep choking supply the whole time, and that is why rents keep rising, and that's why quality, people, obviously, there are secondary and tertiary markets where they're suffering, but to continue to build new places, to have the opportunity to create new environments, it's fantastic. The problem is that you then people can't keep up with it, and so it becomes unaffordable. And so we have to work out a way whereby that wealth and affluence and all the rest of it and value does still stick with the people who need affordable housing, who need affordable workspace, who need affordable jobs at that level. And so balancing that out is still tricky.
Marcus, do you have anything to?
Yeah, I think just touching back on, obviously, again, my perspective and my sort of daily market I know it's a very warped market and a very warped world. But something I noticed recently, which I picked up on, was quite an interesting data point. And I think the average age of a buyer globally with $25 million or more to spend in the last 10 years has been reduced by 12 years. And what I mean by that is the average age of the buyer with $25 million or more to spend is now at 45 years old. And I think that huge notable shift is actually having an impact on how patient they are with their investment views and their investment perspectives. And yes, a lot of these people akin the high-end residential property market to, you know, the finer pieces of art that they may buy in the same auction houses. But I think it's changed their perception, their shift in mentality to how patient they can be to look at that capital appreciation, their growth of their assets.
Thank you. I think we have a question here on the front row, do we?
Hi, it's Susanna Rock from Gravity. I wanted to go back to the point, maybe sorry if I'm going back to a point we just discussed, but in the context of rising interest rates, widening yields, I appreciate there may be some growth in rent, but we know that the cost of living in London is already extortionate. Wouldn't you expect, and at what point would you expect a price compression? I mean, property values actually reducing from where they are, because I see that as a required factor to, you know, make housing effectively affordable. I believe that the lag that this has is an issue, because by the time prices will go down, you know, inflation is going down as well, interest rates should resort down. So very keen to understand what your expectations are on that.
Well, I mean, it comes back to my point, supply has to exceed demand. And then there'll be too much space around. There'll be too many of us fighting with each other for occupiers or office space, you know, that's not being taken up. And at that point, rent will begin to start dropping again. So that's the Bank of England can't do anything about this because they don't control the planning system, but the government does. And you know that must be the way to go, and then that will stabilise, and then that yellow mustardy bit of your graph will drop down because services won't have to keep rising in order to, you know, meet the market demand. So that planning gets a really bad deal, I know, but the truth is it does take an awful lot of time, and you have to go through a long period of investment before you can start anything. And so there must be ways of speeding that up in priority areas. And whether that's a locational priority area or a sectoral priority area, that's where government should be stepping in and saying, you know, there's an infrastructure commission. You know, real estate in some cases is infrastructure. I mean, it isn't just kind of, you know, posh stuff. It is actually fundamental to the way people live and work and what they do outside of living and, you know, while they're living and working. So that's to me has got to be the thing that will unblock the dam.
I couldn't agree more. Rob, did you have something to add?
I was just going to say I think it's a great question, and I remember maybe a year, 2 years ago when we started realising interest rates were going up, saying, you know, this is likely to have a consequence for asset prices, meaning property values. And certainly in commercial, my sense is you have seen a really significant decline in valuations in response to the increase in interest rates. But it's really striking that the data on residential house prices is being basically flat, maybe come off a tiny bit, like maybe 3% over the last year, according to some measures, but compared to possibly 30 for commercial.
But to be honest, that isn't as a result of interest rates. That's mostly to do with the pandemic and people not coming into the office. Okay. I genuinely think, I mean, you guys would know better, it's about new ways of working and businesses not needing as much space as they needed, rather than thinking, oh, I can't afford to rent this because of the interest.
Thank you.
Sorry.
No, not at all, and that's really striking. But nonetheless, it does feel like very different. So why is residential so resilient? And I think one of the stories is about forced sellers. And you know, I said that unemployment's barely gone up, and hopefully won't need to go up that much. On top of that, the banks are being supervised in a way to encourage them to be flexible with their lenders. So if people have a mortgage and they're struggling with mortgage payments, if they talk to the lender, they should be showing flexibility and forbearance. And for a long time, the Bank of England has been saying to the lenders, just because interest rates are low doesn't mean you should go on a big wave of lending. We need you to be careful about that. We want you to test people to ensure they can afford their mortgage, even if rates go up by 3 percentage points. So there's been a lot of affordability tests, and all of that has restricted mortgage growth, so that we're hoping that even though interest rates have gone up a lot, it's not going to cause an awful lot of people having to force sales and you know, defaulting on their mortgages, etc. And not having forced sales, I think, is part of the support to the residential market. But perhaps what you could expect is, if interest rates are going to be higher, you know, looking forward compared to where they have been, maybe house price growth is going to be pretty low for a long time relative to wages. And so, if you like, you might see a bit of a correction in that way. But will you get a crash? It certainly doesn't. There's nothing at the moment that you can see suggesting that's happening.
Thank you. Mike, did you have a question? I'm going to try and speed this along, get hands up and get the mics in your hands so that we're making best use of the time. But
thanks very much, Andrew. Three of you have talked about the yield curve, which I think is fascinating. It affects all of our lives, and I'm old enough to have seen the yield curve move around a bit over the last sort of few decades and cycles. But the inversion of the yield curve, the small inversion at the moment, to me, historically means only one thing, but it's different this time, isn't it? QE being one, the political impact on the yield curve with the uncertainty over the Liz Truss government. And I'd be interested in your perspective as to whether or not forecasting is even more difficult this time round because of the way that yield curve moves. And this isn't just addressed to Bob, because I think the two of you have also made some interesting comments on the yield curve, because it is so important to what we do and what we plan for.
Well, I mean, I looked at a chart of this recently, and if you look at the UK 10-year government bond yield, you know, it's moved around, of course. It's been broadly 4% for a long time. It came down. It was 1% in January 22, and it's now 4.3%. That is the biggest rise we've seen in the yield curve since, you know, since the early 90s, or perhaps way before then. So it is incredible how big the awful tightening we've seen in that yield curve has been for your sector. And it's been the biggest shock. You'd never have expected it to happen. And it's a very, very difficult thing to deal with, and we're still seeing the consequences. So does that make forecasting more difficult? Absolutely, yes. The only thing I'd say is that personally, this isn't a Bank of England view, but personally, I don't put loads of weight on the sort of, oh, if you see the yield curve do X, then you can always expect Y later on. I just think of the economy as something that gets hit by shocks, and every time it's different, and difficult to spot these regular patterns. Instead, you just have to think about the shocks playing through and how they're likely to play out. And our story is, interest rates have gone up, the yield curve has gone up, and it tends to take quite a while for those things to play out. So over 23 and 24, what we're watching is the increase in interest rates play out through the economy, and that's going to be painful.
I mean, here's what I'd say. If you read about history, if you take guys like Niall Ferguson and others, I think it's important to think about the fact that history is completely unpredictable. Period, full stop. It's lovely in hindsight to look at this happened, and because of that, you could have imagined that these three things would have happened, and therefore, and that's just not how history works. That's not how the world works. And so my view on forecasting is it's a function of politics, not economics. I think economics is usually a reaction to politics of some variety. And so the idea of forecasting is never doable, fundamentally. So for us, I think planning and forecasting and planning are different things. We really do almost no forecasting. Kind of 1 year in advance, you think about what your rents are going to be and how much you're going to pay for things. But other than that, it's really about creating a range of outcomes and trying to plan for survival. And that's really our business plan. You know, when I got into business, my dad, who set up our business in Canada a long time ago, said to me, it's a really simple business. There's only one rule. Don't go broke. Yeah, that was it.
Yeah.
Everything other than that, you'll be fine, as long as you don't go broke. And that is really the fundamental principle that, you know, and we've been through a lot. I mean, in my short career, you know, we've been through the GFC, COVID. I can't even tell you about a whole bunch of other things in hotels, the Ukraine war, all those things. And the one thing we've managed to do so far is survive. And that's really been the goal. And the truth is interest rates went up and they went down and then they'll go up again. And so how we plan for fundamental supply and demand. And he said, the other thing he said is there's only one way to go broke. Two ways to go broke, sorry. Too much supply and too much debt. So if you can avoid areas where there's tons of supply, which is if you look to your question about housing in the US, there's tons of supply. So go look at multifamily in the US right now, and there will be a lot of problems in the next 3 years. Despite that, generally speaking, there's a housing shortage, and generally speaking, there's lots of things. If you go to Nashville and Austin and Charlotte and all the wonderful places we read about for 3 years, they're going to get 5–10% new supply in a year or two, and there will be real challenges with interest rates going up. So too much supply and too much debt. In the early days, I remember when we started buying real estate here, we were borrowing 90%. That doesn't happen anymore. And so those are the rules. And what happens with interest rates, I wouldn't even begin to look at the curve in that sense because it's just too hard to figure out.
Your dad sounds like a dude. I'd really like
Yeah.
I'm going to move it on because I'm so conscious of your time. Now, we have presented questions, and so I'm going to kind of cover two in one and just ask an open question to the panel. Last week we had Bletchley Park Global Summit on AI, and everybody's hearing about it. I'm not sure who understands it. I don't. And obviously net zero and ESG. So across the panel, I'd like to ask, what do you see where will we be in 3 years' time, for example, and what will have the greater short-term impact? David.
Okay, so I think they're both going to have an impact because I think the whole thing around carbon is based on data. The way out of the carbon conundrum is going to be data, and AI will help us achieve that. I appreciate there are lots of other things that we have to worry about around AI as well. But the key thing about us understanding our carbon impact is going away from a theoretical desktop calculation of what we might be embodying in the buildings that we're building or how those buildings are going to operate, which is the old EPC rating and the way that generally professionals within the real estate world kind of designed things and delivered things and at practical completion handed over this number of files and said, there you go run the building, it's all done. It's going to move from that to actual data around how you're actually running buildings. Are buildings achieving the energy performance that they said they should be doing? In doing that, are they achieving the carbon outputs that they were predicted to achieve, etc.? And AI will learn from that. I mean, DeepMinds, who were bought by Google, they started actually at King's Cross in a little 30,000 square foot building just above Granger. And they're now in 350,000 square feet there. The first thing they did when Google bought them was they used their algorithm to reduce the whole Google portfolio energy bill by about 80 or 90 million pounds or something like that. And that's what you can do. Now, reducing energy reduces carbon, reduces everything else. So that I think there could be a kind of virtuous circle with all of this, where at the moment reducing carbon is seen as a cost rather than an opportunity to create value or to create savings. And it needs to be the other way around. We need to realize that not only do we need to do it in order to be able to give our children and our grandchildren a planet that is habitable and biodiverse and all the rest of it, but actually it can go to our bottom line as well because we waste so much of it at the moment by not measuring it properly.
Ryan?
So carbon and impact of AI? Okay. Look, I think,
take it wherever you want to go with it. But
I think that the thing about it is when I look at the real estate industry, which we all know is slower to move and less dynamic because we've got all these a whole collection of different assets from different times, and it's complicated. And so because it's complicated, I think it's just slower. And we've seen that, and I do think, to David's point, it will accelerate. I think you need, I know David's thing around net zero is about standards. So if you think about where we all work in IT, the standard became Microsoft Office. If you had 1,500 different types of word processing systems, it would just never work. No one would talk to each other it would be impossible to have any common language. And so I think where we are in that journey is we're still in that place where technology innovation is great, but we haven't got to the bigger, more established players and standards. The good example in internet would be search. You know, you had Yahoo and Alta Vista and a whole bunch of others, and then it coalesced around Google plus a bit. I think we need that, and that will come from innovation and technology innovation, and then I think people can get on board, because I think it's very hard today for all of us who aren't experts and live in that world every day to pick and spend the time, the money, and the investment to then change 2 or 3 times. So I think that we are in a bit of a chicken and egg in that space, but it will eventually rise to the surface. So I think from a carbon point of view, to me, as a user, that's my number one thing that I'm kind of looking for and waiting for to see how I can make it easy. From an AI point of view, there's no question that AI more generally will be more pervasive than anything that's happened since, you know, the internet was introduced around, you know, in the mid-90s. But again, you look at how long that took and where we got to in dial-up and broadband and ubiquity and language, and I think that will come. And AI has been around for a long time. I mean, I've listened to lots of podcasts and talks on it, and the truth about AI is not new. You know, AI has morphed a long time from when the computer said hello to, you know, Big Blue beating Kasparov in chess to where we are today. I think ChatGPT is on that continuum, but it's not brand new. It's certainly accelerating in the same way Moore's Law does. So we're getting there faster and faster. And it will change, no doubt, everybody's job in the room in continually shorter and shorter time spans.
Bob, you wanted to jump in?
I was going to make just a couple of points, if that's okay. I thought, first of all, a gloomy point, and then perhaps a more optimistic point. So on climate, personally speaking, it's not a Bank of England view, but I do find, you know, over the last year, the news seems to me to mean that we need international cooperation, and that feels increasingly unlikely. So I do feel more gloomy about that personally over the last year. I think the news has been pretty bad on all of that personally. On AI, we've been wondering, we've been really worried about how weak growth has been in the UK for the last 10 years or so, and it's basically because productivity has been very weak. Despite the fact that companies seem to be adopting technology, you can't really see it in the data. And we've been asking of late, every business we speak to, you know, how much is AI affecting you? And they're pretty positive about it. And there's definitely a sense, I think, that it will be adopted soon enough to start showing up in productivity data, in the sense that people's jobs are going to be changing, as you said, and I hear lots of businesses saying we can't afford to ignore it. We know we have to get on it. Our clients are saying to us already, how much are you using AI to reduce my costs by, you know, improving the productivity of your people? So in professional services, I'm expecting it to be pretty big quite quickly, and that'll be good for all of us. It'll help raise our productivity, hopefully.
Great.
I'll just throw in a final point here on the AI perspective. So I think just touching on the Global Innovation Index that was just announced, I was really surprised to see that Cambridge was at the absolute top when it came to life sciences and technology patents. There were 6,500 patents that were announced last year, far surpassed San Francisco, Tokyo, Seoul, all of these other major cities that most people would assume to be at the top of the leaderboard. I'm slowly starting to see clients, major investors, start to throw various different acronyms and synergies at me that I'm slowly starting to get to grips with on the residential front. But I think the very basics of our system on the residential market need to be improved, and I think that will come through smart contracts with the law firms that will be adopting. If you look at the average age or the average time frame that a land registry report takes at the moment to be activated, it's 22 weeks, which I think is absolutely ridiculous. I think the live data is hugely important to these investors who are used to trading in other markets and have that live data at their absolute disposal. So I think that will be certainly improved over the next 2 to 3 years through use of smart contracts. And the other point that I think is quite interesting is a lot of my clients are now looking and speaking to me about the tokenization of real-life assets. So real-life real estate portfolios and real-life real estate assets that are tokenized, and people can invest through various blockchain elements. And I think over the next 3 to 5 years, that will be really coming to the fruition and the forefront of the markets.
Thank you. Right, 1 minute left. I'm very conscious of such a distinguished room day and diaries. So I'm going to ask the final question, which is, if I hand a magic wand to you to inject growth, healthy growth into the real estate industry of the UK, what's the one thing that you would change, tackle, do?
I'll kick it off and I'll say a reform on stamp duty. I think that the stamp duty and the aggressive position that we've taken to foreign investors is having a hugely detrimental impact to the market as a whole.
Great. Ryan?
I feel like I'm being unfair to David, but I think it would be hard to have growth without a serious change in planning. And I think if you look at other...
Yeah.
You go this way.
And if you look at places like the US where you have zoning, and even here if you had the presumption in favor of planning as your start point, which today is reversed, you would move things a long way from where they are today.
Thank you.
So I can't do planning, obviously. So I'm going to go carbon pricing, and I know that might sound a little bit anti-growth in the sense that it sounds like it's a tax, but I don't think it is, because I think it's a way of opening up the market. See what Biden has done with the IRA Act in the States, and what the European Union are doing around encouraging investment in this technology. I think there's a huge opportunity for growth in jobs, productivity, and ultimately we can save the planet at the same time. So what's not good about that? So a proper price of carbon, which would allow people to appreciate the value of it as well as the cost of it, I think could actually be, The Economist, I think, would agree with me on this one. So, sorry, you're last now, so you've now got...
Well, I was going to say flexibility, actually, and essentially repurposing. And I don't know, it seems to me that there's big need to sort of shift the use of buildings from one thing to another. And in particular, I'm hoping more residential, taking advantage of the structural changes we've been seeing to convert some of the stuff that isn't residential into residential, and whatever is required to make that happen. But it seems to me that's an opportunity and something I'd like to see.
Yeah.
Thank you. Ladies and gentlemen, it's gone 9:30. I can't thank you all enough for joining us. It's really overwhelming to see. I don't think a spare seat in the room. So thank you ever so much. I hope it's been really useful for you to take away and do what you do. And I'd like to thank the panel. I mean, as always, Rob, we couldn't do this without you. David, absolute legend. I mean, if David was a rock star or group, I have you down as the Stones, I think. Ryan,
I'm the same age as
Ryan.
Slam.
Ryan, I'm going to come up with a group for you. And Marcus, this is payback for you giving me grief for the last 48 hours. But thank you ever so much, and I hope you've had a good time. Thank you.